we are starting with source of financing, or it is called types of financing. Okay, full theory chapter. Okay, you have to just listen what I'm saying. Very important, because different instruments are now, as slowly what is happening is there are more complex instruments have been devised. So we need to understand that, and for understanding that, this chapter is very important. That what are the instrument, what are the sources. A finance manager now, basically traditionally a finance manager, what was his role? To manage a company's finance, looking after the balance sheet and all. But now, because globalization has happened, a global village has come up, so the source of the borrowing has also become important. Source of borrowing means he can borrow from any places from the world, and you have to choose from the best place so that your borrowing cost is lower. Okay, so let's start. So first, what is the question? How would you classify financial needs based on the time factor? Whenever the finance, what the borrowings you want, whenever it is exceeding 5 years, it is called long term source, it is called long term financing. Correct? Why you require this money? Basically you require it for fixed assets. You borrow for what? Land and building. You borrow for what? Plant and machinery. Is it clear? Understood? Or we can say permanent working capital. Sometimes you want the money for more than 1 year but less than 5 years. Okay, so why you need this is medium term, means what you require for, let's say, for advertising, or let's say some deferred revenue expenditures are there, okay, which you have to incur for 4 to 5 years, so you are borrowing the money for medium term. The next is short term, that is less than 1 year, like working capital investment. What you want? Current assets, investment in current assets, that is called working capital. So you want, why you want the money for less than 1 year, that is for working capital. Is it clear? This is the first question. They might ask you to classify the requirement of investments. Okay, what are the various bases on which the financial sources of a business be classified, or list the source? Okay, like what are the long term sources? Okay, one by one now you have to answer. Have you heard about equity share capital? What is equity share capital?
Owner's fund.
Owner's fund. Equity share capital is owner's fund, means what?
Company raises
Like the owners of the company provide fund for the operations.
contribute
Yes.
money.
What is the difference between equity share and preference share?
The preferential rights over capital redemption and payment of dividend.
They have the preferential right. What is those preferential rights?
So for the dividend payment and
dividend.
And in case number
Exactly. Dividend, when it is paid, dividend when it is paid, first you have to pay to preference share. That is their preferential right. When the capital is repaid, winding up of the company, first whom should be paid? Preference share capital. Correct. The rate of dividend is fixed or it is not fixed? Preference share. Generally it is fixed.
Fixed,
For equity, is it fixed or not fixed? Not fixed.
not fixed.
Correct. What is retained earning?
Part of the divisible profit which is retained in the company for growth and expansion.
Divisible profit which is retained in the company for future expansion, that is called retained earning. What is debenture and bond? Is it same? Yes, it is same.
It's a debt instrument.
Generally debt instrument where contract is signed. Debenture means what? Regularly you will get what? Coupon, interest, what we call interest, coupon. Correct. Debenture and bond. Generally Indian people, what they say, bond is issued by government, no problem. But corporates also can issue bond. Debentures and bond, one and the same. Debentures and bond get what? As in regularly you get income at the end of the life, means when the, if it is issued for 5 years or let's say 10 years, if the bond is issued for 5 years or 10 years, at the end of 5th year or 10th year, what you will get? The face value, the redemption amount. Correct, no? Whatever you invested, whatever you give to the company initially, like let's say I bought a bond for 1 lakh face value, So I will give it to the company today 1 lakh. On that 1 lakh, regularly I will get, let's say they have committed 10% interest. So on 1 lakh, every year I'll get 10,000, 10,000, 10,000. For how many years? 5 years. At the end of the 5th year, I will get the principal amount back. Correct? You can have long-term source, long-term loan from financial institution. I don't need to explain this. Venture capital assistance. What is venture capital assistance?
Providing capital to the startup.
Providing capital to the new startup. It's a branch of private equity. If you want to go deeper, it's a branch of private equity. Okay, we will learn on this. We will read. I'm just giving you an idea. What is asset securitization? That is also a long-term source. Okay, what it is exactly I will tell you. International financing like euro issue, foreign currency loans, all these things. Medium term, preference share capital, debenture, bond, public deposit, fixed deposit for 3 years. Means corporates raise the corporates take loan in the form of deposit from the public. Medium term loans from different corporations. Lease or hire purchase. What is lease? What is leasing?
The partial, making a whole time partial.
Lease. Lease means what? Taking on rent. Lease means taking on rent. Lease means taking on rent. Correct na? You make the rental payments. Aircraft industries all take these aircrafts on what? On lease. Because you don't want to make a capital investment, huge capital investment. There was a chapter in the previous CA inter syllabus, but they have removed it, leasing. Hire purchase is what? Taking on installment, correct? Correct na? External borrowing, commercial borrowing. We will learn this. External commercial borrowing means outside the India, you make commercial borrowings. Then international financing like euro issue, that we have to see, foreign currency bonds, all those. Short-term sources, very important. What are the short-term sources? Trade credit means what?
Giving them access.
For both.
Creditor. Trade credit means what? Short-term source. Creditors, we give credit. Bharana, creditors give us credit. That is trade credit. Correct? Source we are talking. Right now? Supplier, from suppliers we get a credit. Creditors we get a credit. Means that is also source. I should pay today, but I am enjoying that free credit for 1 month, for 15 days, whatever it is. So it's also a source of finance. Are you understand what I am saying? Loans from commercial bank. Loans from commercial bank. Fixed deposit for 1 year or less. FDs. Okay, that is also a source. Means you take from public. Okay, or you give a scheme. Fixed deposit for a period of 1 year or less. It's a source. You are getting money. Commercial paper, that we will learn. Advance received from customer. If your customer pays you the advance, in advance if he pays, it is called what? It's a source. Source of money. You can enjoy it. And that too without any cost. Short-term unsecured loan from various sources. There are many sources. Okay. So where you get unsecured loans for short term. So short note on equity capital as a long-term source. Okay. Companies can raise finance by what? By the way of equity capital, subject to regulation laid down by Companies Act, SEBI guidelines, related laws. We know that. Generally, what is the feature? It has a risk. Correct now? Shares are to be paid off only on liquidation. So the risk is the least. From whose point of view the risk is the least? Company's point of view. Cost. Equity shareholders are entitled to residual net residual income. That is from profit after tax. You pay preference dividend. Then whatever is left, okay, that you pay to whom? To the equity shareholders. So their expectations are high because these people are taking, means from company's viewpoint the risk is less. Why? Because at the end there is no obligation, na? Bond and all, there is obligation. You have to pay the interest. Shareholder, no obligation. Correct? So the expectation now as an investor, think, if I am taking more risk, my expectations will be high or low?
Yes, sir.
High. The return for me becomes cost for the company. The return for me becomes cost for the very important part. Return for an investor becomes cost for the company. So if the return for the investor is high, his expectation is high, cost for the company becomes what? High. When you issue equity now, your control, you dilute the control of the company. Means there are new owners of the company. Correct now? What is the advantage? Equity share capital provides a security that is equity based to other suppliers of fund. So a company with a high paid up capital can raise future funds from other sources easily. Means if you don't have any debt, only equity share capital. When you have only equity source, what that company is called? There is no debt.
Debt free.
Debt free company. One. Next. Unlevered company. What we call? Unlevered company. There is no leverage. Levered means what? There is risk. Okay. That is one of the part what we have to cover. So unlevered company means when you are unlevered, you have the scope to raise further debt, or there are many sources right now. Individually also you think now, an individual who doesn't have any obligation, no loan and a good income. Okay. There is one person who has a good income, no debt, he is debt free, unlevered. And there is another person who has too many loans, to whom it is easy to get a loan. To the person who has no debt till this point. Yes or no? So same way for the company also, if only equity is there, they have not taken any debt. Acha, I am asking you whether the company should take a debt or not.
Required optimum.
One by one.
Debt to equity ratio.
One by one.
There should be a balance between debt and equity.
They have to make a balance between debt and how we will come to know that whether there is a balance or not. How to balance?
But
What?
by debt equity.
By debt equity ratio. By debt equity, how we will come to know?
EPS analysis,
EPS analysis. What is that?
earning per share and all.
Earning per share. No.
Or
Financial leverage and operational leverage.
investment.
Financial leverage, operating leverage, whatever is knowledge, dump it. No.
So as long as the return on investment is more than the cost of debt, the debt can be used in the capital.
Yes. Now that is the perfect answer. What it is called? That phenomenon is called what? We will do that. In long-term financing decision, we will do that. Okay. I'll show you with the help of numbers. Okay, very beautiful concept. Trading on equity. Trading on equity. Beautiful concept. I don't want to get diverted. Just what she said.
There in 12
The-
standards.
Yes.
It was there in 12 standards.
Very good. Very good. Very good. So it would be easy for me to make you understand because you have already done. So let's concentrate. Coming back, what she said was, if the return on capital employed is more, like let's say I am earning on capital employed 25% and the borrowing cost is 10%, then I should go for the debt. This is the right way. Neither the debt equity, neither the leverage financial leverages will tell you whether you should go for debt or not. If my earning capacity, return on capital employed is more as compared to debt, debt is cheaper for me. So I should go for debt. Correct? We will do that. What is the next advantage? It is a permanent source. Equity is a permanent source. When you have to repay? Only when there is a liquidation. Correct?
Liquidation.
Yes. There are no committed payment to holders. Dividend is discretionary, so no monetary obligation. Correct? If you want, you can pay. Otherwise, it's okay. Fine. Preference share capital as a source of long-term finance. Preference. Payment of dividend is fixed. I'm not going point wise. Payment of dividend is fixed. Repayment of capital when you have to do. We have already covered this at the time of winding up. Preference share capital I'm doing. Preference share capital when you will repay the capital at the time of winding up. Generally the rate of dividend is fixed. There are some features. Cumulative option. Cumulative means what? If it is cumulative preference share, If it is cumulative preference share, so if you don't pay for 1 year the dividend, the next year the preference shareholder will get first year dividend, second year dividend accumulated once and for all. Are you understanding? So it's cumulative. If that option is there, if it is cumulative, then only you will get. There are non-cumulative also, where if 1 year the preference dividend is not paid, next year you will not get. You might get next year's dividend, but you will not get for the previous year for which the dividend was not paid. Am I clear? Are you understanding?
Yes, sir.
Cumulative, non-cumulative. Redeemability and convertibility. Sometimes the preference shares, they are irredeemable. Irredeemable means once it is issued, okay, when it will be repaid? At the time of winding up. Do you know when the company is going to wind up? No. Correct?
Sir, but we cannot issue irredeemable as per Companies Act, right?
Irredeemable can't be issued according to Companies Act is saying. Correct?
So, but this subject is a global subject, right? So, I mean, why is the answers restricted to
Correct.
Indian?
Correct.
Indian
It's
laws?
not in Indian parlance. Many countries are there where it is means many rules and regulations. Everyone has their own this thing, regulatory authorities, na. So everyone has their own rule. Okay. So sometimes convertible options are also there. Convertible means what? Preference shares will be converted to what? Equity. Okay. Yes. Obviously, the dividend rate of the preference will be higher than equity or lower than equity.
Could you repeat?
I am asking preference dividend. Will the dividend on preference share will be higher than equity or lower than equity? Equity shareholders.
Mostly, I think
It will be less. It will be less.
It should
Because
be lowest.
yeah, it should not be the lowest. I am saying it will be less. Okay, please understand.
I said less.
It should not be the lowest. Please understand. Equity will have highest, and then preference, and then the least is to whom? The debenture. Okay. It's a hybrid form of financing. Hybrid means what? Think na. Preference. Think na. Preference as a rate of dividend fixed. This is the feature of whom? This is the feature of debt. This is the feature of debt. This is the feature of debt. Capital is repaid at the winding up. This is the feature of equity. Therefore, preference is a hybrid mixture of equity plus debt. Is that clear? Okay. What is the advantage? There is no dilution of EPS. If you issue the preference share, there is EPS will not get reduced. Correct? Okay. There is a leveraging. What do you mean by leverage? You have to pay fixed. It's an obligation, one type of obligation. See, there is a leveraging or gearing advantage as preference capital bears a fixed charge. Okay. There is no risk of takeover. There is no loss of control. Preference capital can be redeemed after a specific period, 5 years, 10 years. What is the disadvantage? Preference dividend is an appropriation of profit and is not deductible for tax purpose. After PAT, we deduct preference dividend. From where we deduct preference dividend? After PAT. Correct? Arrears of fixed cumulative dividend may create burden on the company when equity dividend is declared. If there is cumulative, if it is cumulative preference share, then it will get accumulated. And what will happen? There will be burden on the company. Correct? Okay. Can retained earning be a source of finance? Yes or no? Correct. Now that is called plowing back of profit. What it is called? Plowing back of profit. No need to raise. If you have the savings, use that retained earning. And plow back your profit. Means what? Enterprise must retain. See what they are saying. Must hold back or retain a reasonable amount of profit every year for their expansion plans. Correct? So it will be easy for you to expand. If you have the retained earning, okay, that means there is no need to raise any further capital. So there will be no dilution of control. Yeah, correct. No dilution of control. Okay, is it clear? Right? If you want to create capital asset also now, at that time also you can use the retained earnings. Okay, so whatever is the whatever is the surplus generated from operations after meeting all your obligations, okay, you can use it for capital expenditure. So this is called internal fund generation of the company. It is called what? Internal fund generation of the company, plowing back of profit. Okay. Promoters contribution is one of the major of the financing project, is one of the major of financing project. Discuss promoters contribution. Promoter, who are the promoters? Who has the idea? Whose business idea it is? They are the promoters. Promoters, entrepreneur is required to provide what? His fund, initial contribution for any project. Correct? Like how they provide? So they subscribe to equity or preference share, or they have the right issue. What is right issue?
So giving the right to the existing shareholders
Exactly.
to the payment capital to purchase the price at a price which is less than the market price.
Okay. So very best definition means you have the right to purchase. You have the right to purchase at a concessional rate the shares whenever the company issues. Correct? That is right issue. Fully convertible debenture issued as a right to existing shareholders. Fully convertible debentures. Now these are all the options given to the promoters. How they contribute? Either they buy the debentures, either they have the right issue, or they subscribe to the equity preference, or they give the unsecured loan, or they give what? Seed capital assistance. What is seed capital assistance? Initial stage, when you are forming the company, for the formation, okay, whatever is the preliminary expense is borne by whom? By the promoters. Seed capital assistance. Venture capital assistance, this we will see. Okay, internal cash accruals, that also we will learn. Okay, one by one. I am not deviating because we are now concentrating only one question. Please understand. Features. What is the feature? Promoters contribution is the basic source of equity fund. Since their interest in the project, okay, and its success should be backed by monetary investment. I have a good idea, okay, but I'm not investing in that project. Will some other people invest? No. If I am contributing very much, then obviously the other people will also contribute. That shows my confidence in the project. Are you understanding? Correct. Obviously the financial institutions, they will ask for margin before giving any loan. Anywhere, if you go for home loan also now, they ask you how much margin you have. 15%, 20% you should have. I want to buy a house. Okay, 2 CR, 2 crore. So I should have 20%. That is 40 lakhs should be with me. 100% loan is not possible. Correct. So lender also insists on the margin. Lenders also insist. Okay. So margin is required, means promoters contribution is very important. Okay. Bring out the role of subsidy or capital incentive as a source of financing. Subsidy, you remember capital budgeting we did. Subsidy from the government. Correct. Please look at your book. Please look at your book notes. See what they have given. Means there are types of incentives. Why you get incentives? Because either you are setting up, we are talking about the subsidy, we are talking about the capital incentive. Either you are setting up the business in a backward area like Bihar and all. Those states are very backward. So what the government does, they give you the grant. Okay, if you are setting it up, they give you either the lump sum amount or they give you in form of tax rebate. Okay, so you don't pay the tax. Like I remember that some of the areas will get free electricity, subsidized rate of electricity. So that is one way of helping you out to form a business, okay, to start up the business so that your burden is reduced from government side. Okay, so there are conditions. Now what is the conditions? You should have fulfilled the something initial effective steps, like you should have got the permission from the central government or licensing authorities, or you must have spent some of the means you have already made a capital expenditure of 25%. These conditions might be laid down by the government. So if you want to enjoy the subsidy, then you should obviously fulfill these conditions. If you are unable to fulfill these conditions, then you will not be able to enjoy the subsidy. Okay. Going to viability, check viability, project viability. Yes, listen, I know that you can't see me. 1 minute. So I'm saying that I was saying that we have already done subsidy. You remember in capital budgeting. Capital budgeting, what happened? When the subsidy was given by the government, it was an inflow for me, correct? So it's an one type of incentive. Why it is an incentive? Because government gives you subsidy so that you can set up the business in the backward areas. Okay, which is where the regional imbalance what we used to study now and school level and all, that Bihar, UP, Orissa, they are backward areas. So if you set there, okay, the businesses, you get a subsidy, the concession, that concession is called as subsidy, lump sum. Okay, either they will give you a lump sum amount or they will give you the sales tax and all those things are reduced. Okay, this sales tax and all is reduced. Fine, either they will give you rebate in the taxes or octroi, something like that. Fine. So what happens generally now, these incentives, they are sanctioned by this agency as a percentage of fixed capital investment. Means what? Means if you invest 1 crore, 10% will be given by government. Okay, subject to overall ceiling. The maximum limit will also be fixed. That maximum they will give you 20 lakhs, 30 lakhs, something like that. Okay, so that incentives generally it's a percentage. Fine. It forms of the long term means of finance. Obviously, free source of finance because government is giving you the money. These are sanctioned and released to the units only after they comply with the relevant scheme. Means obviously, if you are not running the business, okay, you can't claim that. So obviously, you have to satisfy all the rules and regulations. Then only they will give you subsidy. Now, see, what are the initial effective steps? Means you should form a company to get the subsidy. You should form a company. At least you should acquire some land in the backward area. That means they want your intention to be very clear. Okay, registration for a manufacture of the product, all these things. Okay, these are the initial steps. What are the final effective steps? How you can get the subsidy? Obtaining relevant clearance. Okay, whatever the permissions are required, that you are taking. Correct. There is conversion of letter of intent to industrial license. Means you have got the industrial license. You have taken the industrial license. Okay. Tie up with the means of finance. That is in principle sanction of various finance providers. Means you have tie up for the sources. Means to raise the loan and all. Okay, you have applied. All these are initial steps. Means they want to know that you are genuinely going to do the business. You have not come here for the subsidy. Is that clear? Okay, so all these things are, all these conditions are there. You can go through it. Fine. Project viability means what? The viability of the project must be depending on the quantum and availability of incentive. Okay, whether the project is viable or not, means whether you are going to have some profit or not. Fine, that is what they are saying. So here what they are saying, doing project appraisal project appraisal means while doing capital budgeting, they are saying that this special capital incentives should not be considered. Please understand why they are saying this, that in capital budgeting subsidy should not be considered. This is what they are saying. And some analysts we might have taken in our capital budgeting sum, because in that sum the institute also considers the subsidy in the capital budgeting. Understood? So obviously we should not consider the capital in capital budgeting the subsidies, because we should be conservative now. That is so extra what I will get. Understand? That is what extra what I will get, subsidy. Understood? Subsidy is one inflow. I should consider inflows less. Okay, that is what they are saying. Means subsidies should not be considered for analyzing cash flows and profitability. While calculating the NPV, subsidies should not be considered, because you have to be conservative. Without subsidy, whether you are profitable or not, that you should check. Without subsidy, whether the project is profitable or not, that you should check. That is what they are saying. And then comes the bridge finance against incentives. Okay, a question is there. Let's answer that question. Yeah, go on with the question. Yes. Okay, I'll address it. 1 minute.
Yes, sir.
Correct. So project viability should be checked.
Sir, we might have to refund the grant maybe.
And that is what I'm saying. If you don't comply, if you don't comply the above rules and regulations of the government, you are faking that you are going to build an industry, okay, then it is possible that you will have to refund those subsidies. But 100% if you are going to do the business, then no need. But why these people are saying in capital budgeting you should not consider, while budgeting you should not consider? Why? Conservatism concept. If you get, then it's okay. Understand? If I'm getting, listen now, if I'm getting subsidy after doing capital budgeting, it should get clicked. If I'm getting subsidy, it will increase my cash inflow or it will decrease? It will increase. If my inflow increases, my NPV will be what? More. If I don't take that subsidy into consideration, my NPV will be less. Means I'm following the conservatism concept. There is something called as bridge finance. What do you mean by bridge finance? What do you mean by bridge finance? These incentives you will not get. Listen carefully. In finance, bridge finance means what? For the time being, temporarily, you are getting a loan. That is called bridge finance. You know that you have, there is an independent question you get on bridge finance. Recently also it was asked. We have an independent question, but still I am explaining what is bridge finance. Bridge finance against incentive. You already started a business. Government will not immediately pay you. Government might pay you after 2 years, 3 years. So for that 3 years, but it is 100% sure that government will pay you the subsidy. So for that, you provide the bank with the specific documents, and what the bank does, they provide you loan. And what happens? You will get the amount of the subsidy today. When you get the actual subsidy from the government, you have to repay it to the bank. Have you understood what I said? What is bridge finance? Now, today you are standing here, correct? And you are going to get subsidy here. There is a gap of 3 years. So you take a bank loan here today and you repay it when you get the subsidy. Now, it is not necessary that 100% you will get whatever. Let's say my subsidy amount is 1 crore. So I will get full 1 crore loan. It is called bridge finance. You are bridging the gap. Understand? You are bridging the gap. So the bank might require you should have the margin fund. Bank might not give you full 1 crore. Bank will tell you that you should have, we will only provide with 85 lakhs or something like that out of 1 crore. So that means 15% you should have. Is it clear what is bridge finance?
Yes, sir.
There were many long-term financial institutions which were set up. Okay, like recently you have unsecured loan, government's unsecured loan. Do you know the scheme? Mudra, correct na? Mudra loan, unsecured loan. Okay, what are these? No need of security. Up to 2 lakhs you can take. That is, they have given some name to that. Then for not 2 years, 0 to 2 lakhs or 2.5 lakhs. Then 2.5 lakh to 6 lakhs. Okay, means that those are brackets. You can take up to 2.5 lakhs. If I require more, I can take up to 6 lakhs. I can take up to 10 lakhs. Unsecured loan. But the rate is very high. Rate is 15%. Because it is unsecured, na? So government will also charge you the interest. So this IDBI, what you see today in commercial banking, ICICI, they were not set up for the commercial banking purpose. They were set up for the industrial development. But actually they didn't get a chance, okay, to expand themselves. IFC, Industrial Finance Corporation of India, they were set up for what? To provide the industries with the finance. But actually their performance was weak. Okay, so you can apply to these institutions, IDBI, IFCI, then IDFC, Industrial Development Finance Corporation, ICICI. Now they are on commercial front. But actually they were formed. For what purpose they were formed? They were not formed to make up this commercial banks, means to open saving account and all. They were made to provide the industry with what? With the loans, business loans. National Small Industries Corporation India Limited. Correct. Industries Corporation Limited, NSIC. was formed for what? For small industries. Okay. What happens in India? The minister calls up that so and so person, he wants a loan. Okay, so provide with the loan. There was a point in India where this used to happen, and immediately the bank manager used to sign the check, no documents, nothing. So because of this bank's performance has got affected. Okay, they were actually formed for that, but when they started making losses, they came into the commercial front. What you have to do? You have to give your project analysis. You have to provide with them with a feasibility report. Feasibility report, 5 points. What? Technical. How much feasible you are technically? Okay, that you should say. How much feasible you are commercially, means what will be your sales, what will be your cash flow, economically how you will be good, well off, financially how you will be well off. All these points should be considered. Managerial, whom you have as a managers. All this project analysis means all the positive aspect you should put up in front of bank, and then you get a loan. You should also give them the reschedule of this thing, loan repayment, how you will repay the loan. That also you should say. What is lease financing? Listen carefully. Lease financing. Okay, they have removed the chapter, but a theory question they have given in module. Okay, what is the write a short note on lease financing? It's a contract. Please understand. There is one owner. I have the asset. I have aircraft. I want to lease it, means give it on rent. I permit the another person that you can use this asset for a specific period. So the person, what he does, he instead of buying, he takes it on a rent. Okay, so he has more, means his fund is not getting blocked. What he will pay to me? What he will pay to me? I have given him the asset. What he will pay to me?
Some amount.
Rent. He will pay me rent. Okay, now that rental income is income for the lessor. I will be called as lessor. Who gives the asset is called what? Lessor. Is called what? Lessor. And who takes the asset is called what? Leasee. Leasee, whatever it is. English. Lease may be classified into operating lease, financial lease. What is operating lease? You are using it just for the operating purpose. Means what? You don't intend to become the owner at the end of the life. Please understand. You don't intend to become the owner. You will use it, and after certain years, you will give it back to the owner. Let's say how it is classified, whether it is operating lease or finance lease. Remember, let's say there is an asset which has a life of 10 years. Please listen carefully. And I am using that asset for 10 years, almost 8 years, 9 years. So maximum life is used by me. If the maximum of the life of the asset is used by me, then whether it will be classified as operating or financial. Anybody has a knowledge? Asset has a 10 years life. I am using it for almost 8-9 years. Okay, I have taken it on a lease. How it will be classified? Operating or financial? Financial lease. Because majority of the life is gone. 8 years, 9 years, it means almost for the full of the life I am using the asset. So it will be classified as financial. If I have taken the asset for 10 years and I intend to become the owner, let's say the life is 20 years, and at the end of the 10th year I want to become the owner, means it is given in the contract. We have a contract and it is written in the contract. That will be classified what? Financial lease. If I am going to return it back to the owner after the use, then it will be called what? Operating lease. Okay. Venture capital financing. What is venture capital financing? Refers to financing of high risk venture capital. A new qualified entrepreneur is there, new businessman. He requires fund to shape his idea. Correct. The financer will be called venture capitalist. He invests in equity or debt or entrepreneur. Okay, of an entrepreneur who has potentially successful business idea. He invests in equity means what? Either he will be a partner. When I say invest in equity means what? It's not equity investment. means he will be a partner. I have provided a fund. If I am the partner, that means I have invested in equity of the company because I will get the proportion. I am the owner. If I've given him a loan, then it will be called what? Debt. Right now, generally venture capital financing is associated with heavy capital investment business. Everyone, Tata and these all people, Reliance, they invest, they become venture capitalists. Private equity is booming. This is a part of private equity. Energy conservation, electricity and all heavy investment, solar plant. India is coming up with a floating solar plant. Quality upgradation, all this sunrise sector like information technology. Sunrise sector means which is going to boom. Like in India at one point of time, Bangalore was a center for information technology. Venture capital investor gives venture capital assistance to whom? To the promoter or the entrepreneur. What is the method of venture capital financing? First is equity financing. Means what? Generally the venture capital, venture capital undertakings, they generally require what? Fund for a longer period. But they are not able to provide the returns. Okay, at the initial stage, when I start the business, immediately the cash won't come. So therefore what I do, I take someone as a partner. So it is advantageous to me. But at the same time, I am not giving him the ownership of more than 49%. Because what will happen otherwise? What will happen otherwise? He will become the owner.
He will be.
Yeah.
He will become owner.
So 51% should be stake with me and 49% I will take. So I have given him the proportion 49, 51. So we will have the profit sharing ratio. Conditional loan means what? These are the second type. That was the first type. If you want a venture capital, that is the first option. Second is what? Conditional loan, repayable in the form of royalty after the venture is able to generate sales. You know that after 5 years, the sales will be boom. Means 5 years is a gestation period. So what you do? You say that whatever the sales will be generated in future, I will pay royalty on that. No interest is paid on such loans. The rate of royalty is 2% to 50%, may be based on factors like gestation period, how much time it is going to take. Longer the time, longer will be the rate. Yes or no? Because longer will be the risk for the investor. Cash flow pattern, extent of risk. Sometimes the VCU has a choice of paying high interest, say 20% interest of royalty instead of royalty. Don't pay with the royalty. Whenever you generate a cash flow after 5 years, you pay me 20% interest. Are you understanding the difference? This is called conditional loan. This is the second form where you are not giving the partnership. You have taken a loan. You are not paying interest. You are not paying interest. But instead of that, on such loans, you pay royalty. Whatever the sales is generated in future life, I will pay 2%, 15%, whatever it is. Or else, otherwise, I will not pay you the royalty. It is not based on the sales. I will pay you directly 20%. Okay. Then there is something called as income note. It is a hybrid type of finance which combines the feature of both conventional loan and conditional loan. The VCU have to pay both. Means here you have to pay interest also and as well as royalty also. But at a substantial low rate. Royalty will be low. Okay. Royalty and interest will be low, substantial low, because you are paying both. That is called income note, combination. It all depends, sir, which is famous. It all depends on the people to people, their contract, their understanding. Participating debenture means what? Interest on such debenture is payable at 3 different rates. If you are funding a startup and commissioning phase, at that time no interest, nil interest. Initial operation stage, low rate of interest. Then at a particular, when the operation is reached at a particular level, high rate of interest is charged. That is called participating debenture. Because obviously high rate of interest means what? You are participating. The venture capitalist is participating in your profit because you are making more profit. You have to pay more interest. Because your initial stages, you are having a low profit. So the interest rate is low. Okay. So I'm stopping here. Okay.